What if $800 a month could turn into more than $1 million? Not through a secret stock, not through luck, but through a simple system repeated for 31 years. The surprising part is that you would put in less than $300,000 yourself. Time and compound growth could create the rest. Before we go further, this is not a promise. It is a hypothetical example. We are assuming you invest $800 at the end of every month and earn an average annual return of 7%, compounded monthly. Real markets move up and down. Returns vary. Fees, taxes, inflation, and your investment choices matter. But this example reveals something important. A millionaire goal may be less about one huge decision and more about a monthly habit. $800 a month equals $9,600 a year. That is a meaningful amount of money. For many people, it may require a strong income, lower expenses, or time to build toward. But do not miss the bigger lesson. The number is not magical. $800 is simply our example. The real principle is to invest an amount you can actually maintain. Consistency matters more than making one impressive deposit and then stopping. After the first year, you would personally put in $9,600. With this hypothetical return, the account could be worth around $9,900. That means the growth may only be a few $100s. And that is exactly why people underestimate compounding. The beginning looks slow. You are doing almost all the work. But this stage is not failure. It is the foundation. Every future dollar of growth needs something to grow from. Early investing can feel like pushing a heavy snowball uphill. You add money. You wait. You add money again. And the result may not feel exciting. But each deposit makes the snowball slightly larger. Then future growth has a bigger base. That is how compounding works. Not through one dramatic moment. Through many small moments repeated long enough for the math to begin helping you. Patience is not doing nothing. Patience is letting the system build strength. By year 5, you would have contributed $48,000. In this illustration, the account could be worth around $57,000. Now you can finally see a meaningful gap. Your deposits created the base. But growth has started helping. It is not carrying the whole plan yet. But it is no longer invisible. This is where people begin to understand that the account is becoming more than a place to store money. It is starting to become an asset that can work alongside them. The chart does not grow in a straight line. At first, it often looks almost flat. But as your balance grows, the effect of a percentage return grows too. 7% on a small amount is small. 7% on a larger amount can become much more meaningful. That is why the later years matter so much. People often judge an investing plan by the first 2 or 3 years. But the most powerful part may happen much later, after the account has had time to build momentum. At year 10, you would have personally invested $96,000. But in this illustration, the account could be worth around $138,000. More than $40,000 could come from growth. That does not mean investing suddenly becomes easy. But now you can see that time is doing something real. You are no longer building alone. Your money has started building beside you. And every monthly contribution now enters a much stronger system than it did in year 1. This is the shift most people never reach. At first, your contributions are the main engine. Then your contributions and growth begin sharing the work. Later, growth can become the bigger engine. This is why people say that time in the market can matter more than trying to find the perfect market day. The longer a sensible investment plan stays alive, the more chances it has to benefit from compound growth. But that only works if you can stay invested through boring years, scary years, and uncertain years. By year 15, you would have contributed $144,000. In this example, the account could grow to around $253,000. Now growth makes up almost half the total account. This is the stage where the early patience begins to look different. The same $800 per month is still going in. But the account is now much larger than before. And a larger account gives compounding more room to work. At year 20, you would have contributed $192,000. The account could be worth around $416,000. More than half the total would come from growth rather than deposits. That is a powerful moment. Your money is no longer just growing because you keep adding cash. It is growing because the earlier deposits, earlier returns, and earlier patience are all working together. That is the compounding effect becoming visible. By year 25, the account could reach around $648,000. You would have personally contributed $240,000. The rest could come from growth. This is where the math starts feeling surprising. The account may add more in later years than it added during many earlier years combined. Not because you changed the monthly amount, but because the balance itself became much bigger. Your past consistency begins producing more visible results. After 30 years, $800 a month could grow to around $976,000 in this hypothetical example. You would still be just short of $1 million. This is where many people might think, I failed. But look closer. You have built nearly $1 million through a repeated monthly habit. And you are only one more year away from crossing the line. The lesson is not that $1 million is easy. The lesson is that consistency can move a giant goal into reach. At year 31, the account could cross $1 million. You would have personally contributed $297,600. The rest, more than $750,000, could come from compound growth. That is the surprising math. You did not need to invest $1 million. You built the base over time, then let time and growth do more of the work. But remember, this result depends on the return assumption and staying invested long enough. There is one more important truth. $1 million decades from now will not have the same buying power as $1 million today. Inflation can reduce what money can buy over time. That is why $1 million target should not be treated as a finish line by itself. Your future needs, lifestyle, healthcare, housing, and location all matter. The goal is not to chase a number just because it sounds impressive. The goal is to build real financial security for the life you want. You do not have to invest exactly $800 forever. Maybe you start lower. Maybe you begin with $100, $200, or $500. Then your income grows. A debt payment ends. Your budget improves. You can increase your monthly amount gradually. Even small increases can change the final result over long periods. The habit comes first. Then the contribution can grow with your income. A financial plan should support your real life, not make your real life impossible. The path will not be smooth. Markets can fall. Your account may go down for weeks, months, or longer, and future returns may not match this example. That is the risk of investing. But reacting emotionally to every decline can break the system before compounding has time to work. A long-term plan needs enough cash savings, manageable debt, and a level of risk you can actually tolerate. You do not need to predict every move. You need to avoid being forced to quit at the worst time. Do not confuse long-term investing with betting everything on one exciting idea. One hot stock can rise quickly. It can also fall quickly. A diversified approach spreads risk across different investments and can make your overall plan more resilient. Diversification does not eliminate risk, but it can reduce the damage caused by one bad decision or one company failing. $1 million goal is too important to depend on one headline, one influencer, or one lucky guess. Build the foundation first. The easiest way to stay consistent is to automate. Set a planned amount. Connect it to payday. And let investing happen before the money gets spent on something else. You should not need to feel motivated every month. You need a process that works when you are busy, tired, excited, worried, or distracted. Automation turns a good intention into a financial habit. And habits are what give compound growth the years it needs to become meaningful. Can $800 a month make you a millionaire? In this hypothetical example, yes, after about 31 years. But the deeper lesson is bigger than $800. Start with what you can maintain. Invest regularly. Diversify. Increase contributions when your life allows it. Keep fees and risks visible. And give your money time. The $1 million result is not built in 1 year. It is built through ordinary months repeated long enough to become extraordinary. Comment below, what monthly amount could you realistically start investing today?